Section 216, explained, a guide to non-resident rental income tax in Canada. Non-resident rental income in Canada is subject to specific tax regulations under Section 216 of the Income Tax Act. Understanding these requirements is crucial for individuals earning rental income from Canadian properties while residing outside the country. In this article, we will delve into the details of Section 216 tax and the implications for non-resident landlords. What is non-resident rental income? Non-resident rental income refers to the income generated from renting out Canadian properties by individuals who are not Canadian residents for tax purposes. This could include rental income from residential properties, commercial spaces, or vacation homes located in Canada. Section 216 tax requirements. Under Section 216 of the Income Tax Act, non-residents receiving rental income from Canadian properties are required to file a Canadian tax return. This ensures that the income earned is properly reported and taxed in Canada. Additionally, non-resident landlords must adhere to specific tax withholding obligations set out by the Canada Revenue Agency, CRA. Tax rates for non-resident rental income. The tax rate applied to non-resident rental income in Canada is generally 25% of the gross rental income. However, certain tax treaties between Canada and other countries may reduce this rate. It is important for non-resident landlords to consult these tax treaties to determine the applicable tax rate on their rental income. Reporting rental income. Non-resident landlords are required to report their rental income by completing Form NR6 and submitting it to the CRA. This form allows landlords to request a reduced withholding tax rate based on estimated expenses and deductions related to the rental property. By filing Form NR6, non-resident landlords can potentially lower their tax obligations on rental income. Compliance with Canadian tax laws. Compliance with Canadian tax laws is essential for non-resident landlords to avoid penalties and fines. Failure to report rental income or withhold the correct amount of tax can result in significant consequences. By staying informed about the Section 216 tax requirements and fulfilling their obligations, non-resident landlords can ensure they are in compliance with Canadian tax laws. Quotable quote, understanding the tax implications of non-resident rental income in Canada is crucial for individuals earning income from Canadian properties. Compliance with Section 216 tax requirements is key to avoiding penalties and ensuring a smooth tax process. Tax expert. Conclusion. In conclusion, non-resident rental income in Canada is subject to specific tax requirements outlined in Section 216 of the Income Tax Act. Non-resident landlords must understand these regulations, report their rental income accurately, and comply with Canadian tax laws to avoid any issues. By staying informed and seeking guidance from tax professionals, non-resident landlords can effectively manage their tax obligations related to rental income in Canada. Understanding the nuances of non-resident rental income tax requirements for Canada is essential for individuals receiving rental income from Canadian properties while residing outside the country. By adhering to Section 216 tax regulations and fulfilling their tax obligations, non-resident landlords can navigate the Canadian tax system with ease. Need help managing your non-resident rental taxes? Call 416-283-8774 or visit theaccountingandtax.com.